episode is brought to you by the Consultancy Growth Network. As you'll know, I'm a big believer in learning from people who've achieved the things that you want to. It's why I run this podcast, to share the stories of consulting leaders and how they've got to where they are today. So when I started talking to Mark Jansen and the team at Consultancy Growth Network, it was clear there was an obvious fit between Climate Consulting and their mission and what they are building with their network. But you're probably asking, what is the Consultancy Growth Network? The Consultancy Growth Network is the leading community of boutique consulting leaders. It brings together seasoned consulting growth experts who successfully scaled their own boutiques, with rapidly growing consulting founders looking to emulate their success. Now, you might be thinking, who are these growth experts? What do they actually know about consulting? And this is one of the most exciting things that personally I find about the network. The team at the Consultancy Growth Network have searched far and wide for some of the best boutique consulting leaders to help their members on their journeys, some of which I have previously interviewed for this podcast, such as Don Morehouse and Augusto Negrillo. But it's not just the insights from these people that you will benefit from. By joining, you get access to their jam-packed calendar of regular in-person and online events, their comprehensive growth hub of resources, and their active Slack community. Through all of these channels, you can learn, solve challenges, and achieve the goals you want for your firm. And now, if that wasn't enough reason to sign up, the Consultancy Growth Network is giving all listeners to this podcast a special sign-up offer. If you join for 12 months, you join for that next year, you will get your 13th month for free, giving you that extra month to continue to build on everything you're learning and continue to benefit from the network. To sign up, just visit consultancygrowthnetwork.com or contact their partnerships director, Luke at consultancygrowthnetwork.com. And when you're talking about joining, mention Create Engage or Climate Consulting, and you will get that special sign-up offer. Hi, and welcome to today's episode of Climate Consulting. In this one, I am joined by Alex Thomson, partner at private equity firm Growth Capital Partners, one of the most active investors in the consulting and tech services space. Now, if you are thinking about scaling your firm, selling it, or you just want to understand what really drives growth in our sector, then you are going to love this conversation. It is packed with so many insights that you just will not hear anywhere else. Alex and his team have worked with some of the biggest success stories in the consulting world and have achieved some phenomenal results working with brilliant consultancies in their portfolio, including Hippo Digital, Infinity Works, and Chaucer, to name but a few. And today he shares what it was that these firms and these leadership teams, what it was they did right. He also shares what is it that in all of their experience they've seen people do wrong, so you can learn from it. And he gives you the tools and tips you need to set your consultancy up for long-term success, regardless of whether you are looking for private equity investment or you just simply want to grow a fantastic consultancy. In this one, we cover a whole host of topics, from scaling your leadership team to what is it that drives profitability to the reality of private equity investment. Something that so few people in our industry have ever been through, but something that I know so many of you really want to know about. And the spoiler alert from Alex is it's not as scary as it first may seem. So whether you are an owner of a consultancy, whether you're a leader in a consultancy business looking at how to help it scale, or potentially you just want to hear about how private equity investment works in our world and the key levers and the key lessons that it uses, then you are going to love this one. So with the intro done, all that's left to say is please enjoy today's conversation with Alex Thomson. Alex, welcome to the show. Thank you for making the time today.
Hi, Nick. Thanks for having me on.
So to kick us off, it'd be great to actually just set the scene and for our listeners, share a bit on who you are and who Growth Capital Partners are. For anyone who doesn't know, can you give a bit of your background and the firm's background too?
Yeah, happy to. So in terms of personal introduction, I'm Alex. I'm one of the 6 partners at Growth Capital Partners, or GCP, as we abbreviate to. Personal background, common to many people in this industry. I trained as a chartered accountant, so I spent 3 years with PwC, then spent 4 years working in advisory, investment banking, sort of supporting businesses with raising capital, M&A, even a couple of IPOs. And the bit that I enjoyed the most of that 4-year journey was working with slightly smaller, slightly more entrepreneurial growth companies that were often private or even delisting. And they were going on a journey with the support of a private equity sponsor to scale, to acquire other businesses, to invest and grow ultimately. And that always seemed like an exciting journey to be part of. And that then sort of prompted the move from investment banking into private equity. So I joined this business nearly 14 years ago, which is quite scary in terms of how quickly that's gone. You sort of measure the life of a private equity career in fund cycles and deals, which is usually sort of 3, 4, 5-year milestones. So that's how it kind of slips by so quickly. But I joined this business at a really exciting point in its evolution. So it had recently spun out of a larger financial services organization. There were a relatively small handful of us in the organization. I think I was probably one of the earlier employees, probably number 4 or 5, something like that. And really joining a business that had raised capital, had a track record of investing in UK SMEs. Maybe we'll sort of touch on what we mean by that a little bit later. And it was going on a journey backing founder owners, entrepreneurs, people who were creating great businesses, developing exciting products, introducing and evolving services. And it was just a fun place to be part of, and great to be sort of exposed to that sector of the UK economy.
Amazing. Well, I love the story. I didn't realize that was the history of yourself or GCP. And like you say, I imagine a great time to join way back 14 years ago. What fund are you on now, just to that cycle point?
So when I joined, we were starting to deploy Fund 3, which was the first one we raised as the partners at the time raised as an independent private equity fund. And we are right on the cusp of going out this year, hoping to raise our 6th fund. So I've been on the cycle of deployment of and realization of Fund 3, sort of deployment and partial realization of Fund 4, and deployment of Fund 5.
Wow. And I realize, Alex, because the reason we're talking today is private equity is one of those hot topics in consulting and professional services. And lots of people talk about it. Not that many people, I guess, know about it. Unless you've been through a raise, you've been on that journey. It's a world that still many people know the name, but they won't really understand what it involves. And I wonder if you could give us almost a very quick primer. You mentioned there you raise a fund. You mentioned SMEs. Like, in the GCP context, what does that mean? Who are you raising money from? Where are you deploying it? What are those businesses you're helping?
Sure, yeah. So at its simplest, private equity is a firm, a group, a manager, as we call it, that is effectively raising a pot of capital from third-party investors who want that capital to be invested in growing businesses that have particular characteristics and a particular strategy. So they allocate capital, and then the manager makes a decision about where to deploy it. So in that context, it's really similar to public markets, long-only type investors, or wealth managers and different sort of institutions that will invest all of our pensions and different things like that. So private equity is just a strategy within overall wealth management. The characteristics around it are we invest, as the name suggests, in private capital rather than public markets. Businesses are already IPO'd. And where we play as GCP is what we characterize as the UK mid-market or lower mid-market. And so that typically means businesses that are beyond the startup phase. So they have got some scale. They've been going a number of years. They've got well-established customers. Revenues are probably somewhere north of 10 million. They're profitable businesses. They're doing something right. They're already sort of well-established. But they want to go further and they want to scale. And that's the bit of the journey that we tend to get involved with. And we bring sort of experience, we bring sort of value creation strategies, we bring capital to support them in that journey. So for us, what we're tasked with doing is investing that money that investors trust us with, sensibly, wisely, on strategy on their behalf, and then support the businesses that we invest in order to scale, and then ultimately create a realization event that might be exit to a strategic trade buy, it might be a larger private equity fund coming in for the next phase of the journey, or it might be IPO.
Fantastic. And I think for our listeners, just really helpful, to your point, to have that definition and those numbers, that while obviously there's plenty of businesses below that threshold who are growing, for you and for where you focus and for some of the things we'll talk about today, that kind of 10 million, I'm assuming kind of 1 to 2 million EBITDA or profit and upwards, that's where you guys play. Yeah,
pretty much bang on. So there's no hard and fast rules. We're not prohibited from investing, and indeed have backed businesses that have been ever so slightly smaller than that slightly arbitrary 10 million. For us, it's just a good rule of thumb in terms of where we should focus and sort of identify the businesses that are probably coming into the stage where they're on mandate for us, but also where our toolkit, our value creation strategy, our experience can best help them.
Amazing. Well, and that, I think, Alex, brings us nicely into what we'll spend the whole of today talking about, that ultimately value creation in all facets, because all of our listeners, all of the people that you work with, they want to grow their consultancies, and you have done this as a fun time and time again. So I'm always fascinated about what are those commonalities, because you will have seen enough services businesses to know there are. And maybe that's where we start. I like to think chronologically. So there is a kind of start, middle, and end. But if we start with that, you are looking at firms or you've just bought into a firm. What are those common challenges you find for consulting firms when they are at that 10 million size? What are the things you're like, we know we're going to have to solve these 5 things when we go in?
That's a pretty broad question to begin with. So I'll try and break
I'll let you take it where you want to take it.
I'll try and break it down a little bit, because we write sort of 100-page investment papers that kind of capture all of this stuff. So I'll
give me 100 pages in 5 minutes, please.
I'll try and be sort of a bit more succinct than that. So look, starting point, that again, I don't want to get hung up on that sort of 10 million number. So we typically back businesses that can be 10, 20, 30 million plus. So the common characteristic is a business that has got momentum, is growing, is still typically either founder or sort of immediate post-founder led. So quite often we're the first institutional or sort of third-party capital into that business. So you're often backing individuals and sort of effectively going in not as a sort of corporate investor, but as a business partner to the people that are already driving the business. But if we look across all of these different situations, and we can be backing businesses in different subsectors, clearly the focus of today is on consultancy, but we've backed technology businesses, we've backed sort of technology services businesses, we've backed sort of broader professional services firms, all with different areas of expertise, serving different sectors and often in sort of somewhat different geographies. There's usually a series of common themes, or at least common areas that we tend to focus on. And this is partly, this doesn't happen the day we make the investment. This happens almost from the first meeting, in terms of assessing what's the maturity of the business that we've been introduced to across a number of these different dimensions. So we talk about our value creation plan. There's sort of broadly 6 elements or 6 pillars to that. And that's sort of strength of leadership and depth of leadership. It's how mature the finance and operations and the sort of the data out of the business is. It's the fundamental shape of the business, what it is, how is it shaped today? Where does it want to get to in terms of how that will look like at maturity? There's a whole other piece around talent and recruitment. Another important pillar is sort of the commercial, the go-to-market. Why do people buy your services? And finally, sort of proposition, or ultimately, what is it the business really does and what is it known for? Where is the sort of technical capability and quite often alignment with either a third-party technology or a domain expertise or a sector? Where does the sort of the clever bit sit in the organization? So across those 6 pillars, there will always be a wide range of maturity. So some businesses will really over-index in 1, 2, 3, 4 of those pillars. Some will be a bit lightweight in others. And for us, that's partly around the assessment of the quality and frankly how exciting the business is. But it can also be an area of opportunity. So just because a business might be underweight in one or more of those pillars, it doesn't mean it's a bad business. Quite the contrary. It can be a business that's focused in and had management bandwidth really dedicated on accelerating on 2 or 3 of those pillars, and is really, really good at those. And so for us, the opportunity then is, well, actually, if we can sort of catch up or develop maturity in a couple of the other pillars that they're a bit underweight on, this is going to be a really nicely balanced, successful, scalable business. So this is all about assessing where they are on the journey and then identifying the areas that we can really help accelerate on to create value.
I think a great way to hone my very broad question, Alex, and gives us, I think, 6 really interesting areas to explore as well. Just to your point of that, different businesses will have different makeups of those. And I appreciate, across the 6, it will vary. Are there any common themes, either strongest or weakest, when you typically, or maybe a different way to ask it is, for the deals you pass on, is there a common weakness that you see?
That's a question that sort of got me slightly pondering. And the simple answer is no. There's rarely a bullet that kills a deal for us, or a single factor that we see time and time again and has as meaning we're unable to invest. In terms of the common themes, probably most of the businesses that we meet have a similar challenge. To take on private equity investment, clearly there is an element of wanting to take on capital, and that might be for a number of reasons. That might be to personally de-risk, it might be to recut the share register, it might be to bring other people into the equity that need incentivization because they're becoming increasingly important to the business. But private equity, you tend to also take on that capital because you want a broader level of support or tools or experience that private equity brings. And so the very fact that you're having those conversations usually suggests that actually a management team or a founder has got to a point where actually they recognize that a partner coming in alongside them can help them solve some of the business problems that are potentially, either inhibiting growth or have, the risk of doing so if they don't sort of change things in the business. And private equity can usually help with a little bit of that unblocking, but also with an acceleration as well. So it might be we're going on really nicely as we are as a business. We're growing at a steady rate. Everyone's happy, but actually how do we go a bit quicker? And again, private equity, bringing that sort of experience and the value creation strategy, that can often help with, well, how do we might be on track to deliver growth over sort of 4 to 5 years, but actually how can we do it in 2? And so at the heart often of the early conversations we have with founders, entrepreneurs, management teams are seeking to bring on investment. It can be, okay, let's unlock what it is the business needs from a partner. Does that align to our skill set and our experience? And then how do we sort of map out a program of how we can support it?
I think to that point, because I love what you're saying there around the speed, the speed of growth that it can unlock and actually that ambition. And it's something, because I was on my list to ask you about, because it might bring this to life for our listeners, is actually how you've done that. Because I always think, past is a predictor of future. And I know, when we were talking ahead of this, you shared a case study of, one of your portcos where you tripled EBITDA in 2 years. Like, wherever you're starting, that's a good number. And if you're at 1, 2, 3 million, that's a really good number. I'd love to, and again, this is a big question, 2 years in 5 minutes, is what were some of those component steps? Because that unlocking sounds like it's a really big part of this journey, is if you can unlock those elements, that's the accelerant that you bring.
Yes, I think the case study you're referring to there is a business we work with called InfinityWorks that was a cloud data and engineering consultancy based out of Leeds. And we were privileged enough to invest in that business back in 2019. I hesitate to say we helped them. We sort of did sort of the trebling of EBITDA, because there'll be sort of various founders and managers of that business that will feel pretty indignant at that, and rightly so. But
right. What did they? It's a good point, Alex. And yeah. Apologies to the InfinityWorks founders. What did they do under your
with our support?
With your support, yes. What did they do?
So InfinityWorks was a business that had scaled to about 5 to 6 million of EBITDA and was roughly about sort of 150 people when we originally invested. There was probably sort of 2 to 3 kind of key areas of scaling that really supported the business with its growth. The first was the talent engine. And so that was really around learnings from other businesses that we'd worked with, and an element of sort of unlocking the talent within the organization, the structures around how do we build a systematic recruitment and talent absorption, and then sort of L&D function within the organization, and how do you do that at scale and pace? So cadence of recruitment went up from 4 or 5, 6 people a month to sort of 30 people a month by the time we exited the business. And that was about putting in place the systems, getting the right people playing in the right areas of the pitch, sort of build out that function. Another sort of area of accelerating on the growth was around sort of the go-to-market and the commercial piece. So InfinityWorks was a very well-known, highly regarded consultancy that had sort of had a period of evolution where it really sort of honed in on the messaging around what it did. And that sounds really simple, but actually telling the story around cloud data and full stack engineering made it a much simpler proposition for end clients to understand and then buy. So that was led by a chief commercial officer that we collectively sort of recruited into the business. He was in there about sort of 18 months ahead of the exit, and just did a really great job of sharpening up and sort of doing, sort of leading that whole function in terms of how to just become a bit more coherent about what we want to be known for. And then the final piece really was the sort of the build out of the platform. And what I mean by that is a business that had 4 founders, of whom two of whom were sort of really leading the period of investment that we were involved with, and building out a team around them so that not only could the business scale from that sort of 5 or 6 million EBITDA to mid-teens EBITDA in a couple of years, and grow headcount from sort of 150 to north of 400 over that same period, whilst navigating the pandemic as well. So that was quite an interesting time. But that growth, but also how do we build out the team and the structure so that when we came to that next event and GCP, we divested and there was other sort of realization for other shareholders, the two founders had the opportunity to effectively do a handover and then step back from day-to-day running of the business. So the platform that had been built in that organization was sufficient so that it didn't rely on the two founders. And that's a big part of what we try and do with most of our investments. That's not to say that the founders will always, or let alone have to, exit at that next event. But how do we create optionality so that if that's something that an individual who's still a meaningful shareholder in the organization wants to do at the next event, then if we've collectively done our jobs right, there is a succession-ready board there, there's talent coming through, there's future leadership in the organization that can sustain the business going forwards rather than being reliant on an individual or a handful of individuals.
I think a great example, and actually some really interesting areas for us to dive into, because I think they'll be really relevant to our listeners. And maybe actually, Alex, we start there because your point around actually having the founders not integral to the business makes it easier for them to step away at that kind of next event. I also, from the consultants I've met, it also feels like one of the hardest things, because if you particularly if you founded a business as these two did, you are in part the identity, and in many professional services businesses, the partners are also the sales engine, the marketing engine, and on and on. What was the process to actually remove those founders? And not remove in a negative sense, but delegate their work,
facilitate their exit.
And for anyone listening who's thinking, well, I would love to be in a position where I'm not key man risk or key woman risk. How did you do that?
This is really common. So most of the businesses that we invest with are founder-led. Founders still really important. We have this phrase, the business is an extension of the founder's personality. And I generally mean that very, very positively. So any of the founders out there that I worked with, that's a good thing. But it's all about how do you make that systemic, scalable, and as you say, de-risk key man. And that's really going back to those sort of 6 pillars of value creation, or those 6 areas of value creation. A founder setting out and scaling a business is probably across all of those 6 areas in greater or lesser degrees, and depending on their own sort of skill set, aptitude, interest, what's most on fire in the business. So our approach is really, how do we put in place systems and structures? And that structures usually means people structures. How do we put in place that infrastructure across the business so that you can get great quality data in order to make better quality decisions, delegating authority to the right people, to have the right level of decision making, but with oversight and governance, so that actually that becomes less about a single person making 90% of the critical decisions in the business, and a structure that replicates it and escalates the right issues to the right level of decision making at board level, rather than being a founder juggling, right, what's the most pressing problem I've got on my plate today? Is it I've got a people issue to deal with? Is it I've got a big pitch for a new piece of work? Is it I've got a key client that's unhappy? Again, if we're doing our job right, there are people in the organization and systems aligned to them that across all of those things simultaneously. And clearly, a founder still has a hugely important role in diving into any one of those 3 examples I gave there. But it shouldn't be a question of either or. It should be a point of when they need to do that to add maximum value to the business or protect maximum value to the business, rather than my day job is a series of firefights.
If you are enjoying this episode so far, I have one small ask. I would massively appreciate if you could open your phone right now, hit share, and send this to someone in your network, one of your friends, one of your colleagues, one of your clients who you think would benefit from this interview. This podcast only runs because of you and because of the value you get from it. And it means so much to me to broaden that reach so we can help more consultants to climb in consulting. So please hit that share, send it to a friend, and I'm really excited to hear what they think too. How do you start that journey with a founder? Because obviously it's a long journey, but again, for someone listening thinking, I'd love to do this, is there a part of that growth playbook? Is it audit your time? Is it pick what you hate? Like, how?
Yeah, that's really interesting. So I've worked with any number of really driven, high caliber entrepreneurs. So I'd really hesitate to say to them, this is how you need to spend your time. And I think the vast majority of them would say, well, actually, that's none of your business. And, thanks for your input, but I'll allocate my own time. Thank you. So it's nothing like that. We're not a constraint. We're not a manager. We're not we're not in control of the management teams that we work with. We're a business partner, a friendly challenge, there to support, as required. The critical thing is always that system of delegation and actually breaking out of, it's easier to do it myself as opposed to sort of delegating to a team around the entrepreneur and giving them the tools to be great in their own roles. And so clear lines of responsibility, clear accountability, and making sure they've got the tools in order to deliver, a set of outcomes or a set of KPIs that they're tasked with achieving on behalf of the business. I think that's a critical point in terms of breaking out of this. Well, founder will just get involved and solve the problem themselves. There's always going to be elements of that, but making sure that the people around them understand what they are responsible for, how success can be measured, holding them accountable to that, but also critically making sure they've got the tools to affect that success. You can't give people a set of KPIs, tell them to go and do something, but then make them dependent on either another function in the organization or another executive or C-suite individual, because then it gets into, well, actually, who is ultimately responsible for delivering in this area of the business. So cutting through all of that, making sure we've got suitable clarity around leadership and structure at that kind of C-suite down to senior leadership team or senior management team. That's usually a sort of critical starting point in the org design, and that probably evolves 2 or 3 times over the life of our investment.
One question just to the growth journey, because you didn't mention it, but I know it's something that many sort of growth stories have. Was the Infinity Works entirely organic, or was there acquisitions along that 2 years as well?
So Infinity Works was organic.
Wow, okay.
Yeah, and our primary lens on most of the investments that we work with will always be, is there a strong underlying organic growth story here, and can we sort of supplement it and accelerate on it? We do support with acquisition as well. That we rarely do what's known in the industry as a buy and build, where you're taking sort of platform investment and then you're adding on sort of 2 or 3 businesses every year. What we often do, though, is take that core business that we're backing, and then over the 3, 4, 5-year journey of the investment, well, how can we accelerate on that? And we usually make an acquisition for a couple of reasons. And it's not just scale. In fact, actually, it's rarely for the sake of scale. It's usually to bring a capability or a service offering or a geography that is just that bit harder and longer to unlock organically. Or it might be to take a year or even 2 years out of the plan. So if there's an acquisition out there that can just accelerate it in a couple of areas, and everyone around the board table is sort of supportive of this, and we can make it work, then it can often be a great way of just sort of taking chunks out of that timetable. We keep coming back to this notion of speed, not because we're greedy private equity folk who want to get onto the next exit, but actually that momentum is self-perpetuating. So if we can get a business that's got that kind of growth cadence that's super exciting, it gives us more options as an investor and as a partner to the business to say, okay, where next in the period of our investment? But it also means that we can get to that next outcome quicker. And that might be great for the management team. It might be great for the business because it can then combine with something else and go on its sort of longer term journey that little bit quicker. So for us, it's always working to the drumbeat of set out a credible plan that we want to achieve over 3, 4, 5 years. But in an ideal world, we're sort of pausing or at least assessing at the end of year 2 and saying, right, we've kind of done most of the things we set out to try and do, and we've done it a bit quicker than we thought. So is there is now the right time to have a divestment or that next event, or actually this is really exciting, this is fun, we're all enjoying it, how do we go a bit further?
I'm interested, you mentioned there you don't follow a buy and build. And again, just in case there's an interesting insight for our listeners, why do you favor organic with, to your point, those kind of strategic acquisitions for sector or for geography over we'll bundle 10 of these together and sell them on? So
different funds have different strategies, and our fund, our sort of focus, I mean, the clue's in the name. We abbreviate to GCP, but we're growth capital partners. So what's the G for? It's growth. And that organic growth lens has always been super important to us. It probably goes as well. It says something about the quality of the business. If you're growing organically, that means that you're selling the right services into the right end markets. Your customers love you and want to buy more from you. You're able to attract people who want to come and work for you. Why do they do that? Because you're creating the opportunity for them to accelerate on their career, to take on more responsibility, to become more senior more quickly. Why? Because the business is scaling. So growth has so many different positive opportunities and spin-offs for everyone associated with the organization. It's really exciting being part of a business that's scaling at 30% a year and winning new clients and even entering new geographies or extending its service offering. That's always a fun place to be because you're creating opportunity for people. You're doing new things. The days aren't boring. It can be occasionally a little bit stressful for people. And clearly another part of our role and the broader sort of board and management's role is to make sure that growth doesn't become unstable or unsustainable or, risks breaking bits of the business. But generally a healthy level of organic growth is a fun place to be. To answer your point around putting 10 businesses together, absolutely nothing wrong with doing that. But the thing that I think in the context of a consultancy that's always really important to sort of pause and reflect on is culture. And that's quite a subjective word. I think trying to sort of really tightly define it and almost put metrics against it has been a very, very difficult thing to do across multiple different businesses. But every business that we've worked with, certainly, and actually one of the attractions when we're meeting a new one, is a business that's got a really clearly and well-articulated sense of itself. What makes so I use the example of Affinity Works or other business I'm involved with, Hippo or Ubiquity or CloudRock. What makes a Ubiquity person or a CloudRock person or a Hippo person? And there'll be some hard metrics around that. There'll be some softer, more subjective metrics around that. And talent acquisition is a careful thing. You want people to come into the organization and succeed. You don't want to bring people in where you've probably got question marks around whether they're going to sort of integrate and fit culturally. If you start bringing together multiple different organizations and using this terrible industry phrase of smashing them together, which is awful because you don't do that. Any M&A you carefully integrate, even if you're doing it at volume and scale. But putting together lots of different businesses that might have different parts of the country, they might have sort of different service offerings, they might have different ways of working, they might have a different employee profile. You think about maybe bringing together a business in, say, the northeast of England that's got more of an engineering heritage versus a business that might be based down in Bristol that's got more of a sort of a creative or sort of digital marketing kind of heritage. That they're going to be quite culturally different. At the risk of sort of stereotyping, you could probably flip those geographies on your head if you want, but that will have its own challenges. And so before you do that, you need to be really careful about what it is you're trying to create. Are you going to nudge the culture because that's a part of maturity, or actually are you just doing it for scale? So again, I think it just with these people businesses, with consultancies, there's that kind of intangible value in the business that you've got to be quite careful about protecting.
It's a really good point. And actually it raises a different but related question of, to your point, if you stick two organizations together, there could be cultural differences. Having seen growth in other organizations, there is always also an element of, 10 is different from 50, is different from 100 and on. How do you help your management teams navigate that side of things? We've touched on Affinity Works where the headcount, I think you said 150 to 400. I know with DMW, I think it doubled. Those in and of itself, there is the allergic reaction to another culture. There is also the how do you keep the people who were there on day one that you still potentially want there on day 600. How do you balance that growth? Because you're right, it's exciting. It's also 400 is a different beast to 100.
Yeah, that's a really good question. And actually, I'd use an example of Hippo, the business I mentioned previously. That was a business we backed, invested in Leeds in 2021. Also Leeds headquartered, but has sort of grown out over the rest of the country. So it's got an office in Birmingham, Bristol, London, and Edinburgh as well. Manchester, shouldn't mention Manchester, don't leave them out. That's a business that's very heavily rooted in user-centered design. And so that's build and actually the public sector as well. So a lot of the people had careers in NHS and other sort of government departments before coming into that business. The founder worked in that context as well. And so the combination of public sector and user-centered design, that's got a very strong identity. It's a particular type of person. It's got very high social value awareness. It's got a well-defined culture and type of person that wants to work in that organization, which is great. It's one of the things that strongly attracted us to the organization. That business, when we originally invested, was probably around about 100 permanent headcount. And that's now, I think, as of a few months ago, we welcomed our 500th Hippo into the organisation, which is a really proud milestone for the organisation. And yeah, I think the vast majority of them do like to be called hippos, but there's probably one or two people who object. But that's anyway. I'm proud to consider myself a hippo. But that's an example of a business that's probably gone through about 2 or 3 different phases of its maturity, and that's broadened out its service offering into data and software engineering, as well as the heritage and user-centered design. And I think and it's probably one of the more culturally pronounced organizations that we've worked with. And yet we've had very low attrition. We've seen people go on and have tremendous careers in that organization, despite all the change that has occurred and gone on around it. We think people still enjoy calling Hippo home. And I think a common thread around how do you keep people on the journey is communicate it. People like to feel that they're part of an organization that is going places, is creating opportunity that we sort of touched on previously. And that needs to be something that the whole organization can share in and celebrate and enjoy. Now, that doesn't mean that everybody has to be focused on the next quarter or the next year, or be aware even about the sort of financial metrics of the organization. Great if they're interested in that sort of thing, but clearly people have day jobs and they're involved in different projects and they've got different sort of areas of focus and clients to keep happy, etc. But it's something that the entire organization is aligned to. It's not something that's only kept at board level. And I think if people understand what growth means for them in terms of opportunity, and you can choose to get involved in that opportunity. You can put yourself forward and sort of try and drive your career and take advantage of a new office opening or an extension of a service offering or a new client that the business has won that you're really keen to put yourself forward and work on. Or you can do what's expected of you in any kind of normal professional career. But the more that you are open with people about what we're collectively trying to achieve, I think the more that you kind of get that buy-in, and then people recognize what makes a private equity backed journey exciting, because you're working within particular time horizons. There will be change, hopefully the vast majority of it positive. And again, it comes back to a creating opportunity, and that's for people's careers as well as employees and managers who also happen to be in the equity. So there's a career dimension, there's a challenge dimension, there's feeling like you're part of something that's got momentum dimension, and then obviously there's a financial dimension as well.
No, I love that, Alex. And I do want to come on to the other side of the scale equation, which is how you get the money in to pay for that growth. But just before we do, because I want to close this topic, there's a question that raises, and you touched on there around career growth, for instance, of when you're growing, when Hippo or one of your other portcos is growing at that speed, how do you think about leadership? And I guess both what hires you need to make, as well as the velocity that some of the team can match that. Because, if you're doubling in 2 years, some people will be able to scale their capability at that speed. Some will not. And that's not good or bad. It's just what the world is. And again, for our listeners thinking of that growth plan, how do you approach that to say, yeah, this person's going to make that versus we might need to bring someone in above them or alongside them? How do you approach that?
Again, it's something that's common to most of the businesses we work with. And giving you a very straightforward answer, what tends to happens in pretty much all of the businesses that I've been involved with over the last sort of 14 years. It's a combination of external hires, and it's a combination of internal promotions, and a combination of the existing leadership team of the business that we back growing and scaling in their roles. So quite often when we invest in a business, the senior leadership team, by that I generally mean sort of board level, CEO, CFO, CCO, COO, it could be chief delivery officer, it could be a chief marketing officer. If you look across the suite of different roles there, quite often there'll be people maybe wearing 2 hats, or there'll be somebody that's sort of supporting in one of those roles but isn't yet the finished article. And the function of growth means some people will have a path cleared for them. They can step up into that role and take on a bigger job, and they thrive in it. Other people, we might find that they are very comfortable operating at a particular level, and then actually it might need an external hire to sort of take the business on and take the role on to the next level of maturity. But equally, and one of the most exciting things is when you discover talent from within the organization that comes through, and they're, you might even have barely met them when you make the original investment, but within a year, they could be sitting at the board, occupying a C-suite role. and then even going on to bigger and better things as the period of your investment comes to an end, or the next event happens. And that was the case with DMW, for example, where we had one, maybe two sort of external hires. We had a core team of three that we backed, two of the directors were clear that the next event was going to be where they were going to step back. And so their successors were already in the business, and they came through, joined the board during the period of our investment. And then actually after we exited that business and that sort of continued, the CEO of that business now is somebody that was running a sector team when we were invested sort of 4 years ago. So that's a really exciting illustration of identifying talent in the organization, creating career paths for them to come through, and then sort of trusting them with the leadership of the organization. And that's notwithstanding that you can find some brilliant people and bring into the organization externally and see how it works. The bit for me that's always quite exciting is when that talent comes through and somebody that you remember occupying a particular role when you originally invested is then in a sort of key leadership role as the business goes on the next phase of its journey.
I love that story. And like you say, the kind of actually cultivating those people within and growing that. And, it's a small world. Simon has also been on this podcast, so I've heard about the DMW journey as well. And then the other side of this equation, Alex, obviously we talked about the people growth, and presumably your capital pays for some of that, but you also have to fund, if you're going to go from 100 to 400, you have to get the work in at that scale. And you mentioned in those kind of 6 pillars, I guess this would be that proposition, that go to market. But what is it that enables these, take Hippo, 100 to 500 people, presumably the revenue's commensurately increased. What are those unlocks that enable those businesses to scale that quickly?
So the revenue generating side of things, this is, if I could productize this and guaranteed results off the back of it, then I would have long ago given up private equity, and I'd be sat on my yacht somewhere. And there are any number of people out there that if you follow different kind of business blogs and sort of sales workshops and things like that, there are plenty of people out there who promise that they've got the secret sauce to this and it's all really easy. I'm skeptical about that. I've seen methodologies and different ways of sort of standing up sales organizations, and some of them work very well, some of them haven't. The consistent thread, though, I think needs to be a really strong identity in the business about what it should be famous for, what it ought to be famous for, and that's linked to capabilities in the organization. It's linked to the technical qualities of the people. It goes to the thought leadership of how they approach and solve problems and deliver value on behalf of clients. That's what you're paid to do, be focused on the outcome and have the proof points to support that. I think it's a differentiation in terms of ways of working and how clients will generally have a better experience working with you than another competitor, and having a strong sense of that. And also it's knowing how do you leverage the case studies and the experiences that you've got working with other clients in order to de-risk the solution and be more convincing about extraction of value or successful delivery of a program for the client that you're looking to engage with. All of this comes down to having a strong focus and investment in these areas, and a word I use frequently, which is coherence. There is always a tendency of trying to be all things to all men when it comes to sales. A business that's got a strong sense of these are the things that we should be doing because we're really good at them and we can prove how we deliver great outcomes. That being a starting point, and then building on that and layering on broader set of services or other case studies that then take it into sort of adjacent sectors. That's the way that I've seen growth, sort of sales-led growth, work really, really well. That often is, again, going back to this extension of the founder's personality. That can be the starting point, but usually by the time you come to the next event and you've scaled to 50 or 60 million, that needs an entire function around it. And that starts with chief commercial officer backed with capable salespeople, with a bid engine, particularly if you're sort of pointing at public sector as well as private sector. It needs to be relentless, and that needs to be an area of investment. And that's usually the area that you're putting capital to work without a guaranteed payback on that. But there are ways, and particularly, given our experience and some of the areas that we focus on and some of the people in our network, there are ways of de-risking that. And that's what we try and do when we build that sort of go-to-market engine and really sort of focus in on it.
It's an interesting point, because that is, if we think, again, some generalizations around the consulting archetype, most often it's partner-led sales, not always, but quite often. And to your point there, Alex, I guess the building of a sales engine and money in without a guarantee of money out can be a concept that many consultancies struggle with or become nervous around. How do you take people on the journey? And for anyone listening, how can they go on that journey, whatever size, about actually I might need to invest in this to help us scale?
It's definitely a function of maturity. So what you need to do when you are a 5 million revenue business, and this is something actually you alluded to previously, Nick, this constant theme of the tools and the approaches that work when you're 5, that need to evolve when you're 10, need to evolve when you're 20, need to evolve when you're sort of 30, 40, 50 million. So that constant process of reinvention is critical, and sort of thinking about these problems afresh. There isn't probably a hard and fast rule around when you need to invest X amount of revenue into sales and go to market. I would always suggest that somebody in the organization has, at whatever stage you're at, has a focus on revenue generation and building out pipeline. If you don't do that, sooner or later, that you'll have a problem there. That will either be insufficient for growth, or it might even be insufficient to sustain. And the tendency that consultants have is, because they are very diligent, client-focused people for the most part, you can get very, very busy delivering for your existing clients, but that project, that program of work will generally have a life to it, a life cycle, and at some point that will end. And that can end quite abruptly because the client decides, actually, we've done the thing we want to do, and now we're going to go in a different direction, or it can end after a period of many months or even years. But constantly having somebody in the organization that is focused on, okay, what next is coming into the pipeline in order to either sustain or grow is important. The other dimension that I'd sort of challenge on that as well, and this is one for probably founders or other board members just to think about, is being pretty ruthless with your qualification. And that means we all get really, really excited, particularly when it's a big logo and it could be a really big project and we've got really warm intro and the client is saying all the right things. Everyone loves being around that. That gets really exciting. That might be real and that might turn into a piece of revenue generating work. But even if it does, that could look quite different to what you think it might be from those initial conversations. It could be start smaller and scale. It could move out to the right and you're starting that in 6 to 12 months. So I think having a process and then having a sufficient level of founder board level focus on really qualifying the pipeline and just being honest with yourself about, when do we think this piece of work is going to start? And, they're saying it's £1 million piece of work. Well, yeah, but is it more like, what if it's $500,000? How are we matching our resources? How are we making sure that we've got the right caliber of people and the right skill set in order to deliver the work? But when do we need to start aligning them to a start date? When do we need to, maybe we need to recruit in? So when do we make those decisions? Let's just test this a few times just to make sure that we're not, pinning our hopes, or for that matter, pinning the revenue outcome for the year or your budget or your growth on single points of failure that actually we're being a bit over optimistic that they're going to come through in the nature and time that we think.
No, I think a great point. And like you say, that actually it's always easier to jump on the latest deal and run with it. But actually having that process around qualification, what's your sales process? Because again, we do marketing, so we see a lot of this. There are many consultancies where that is not as evolved. We're not here to talk about it in depth, but there's no CRM, there's no sales process, to your point, no qualification criteria. And actually, it sounds like from what you're saying that that's a big thing as you scale. One other thing, and I know you helped Chaucer with this, and it's, again, if I think things that I see a lot of consultancies try, not many actually succeed. So I'm always interested to talk about the successes, is that international expansion. So again, I've lost count of the number of consultancies who have grown in the UK and then try to make the step across. And some do, some don't, some stay in the US, but stay, it's 5 people. I know you helped scale the Chaucer US business. Were you involved when they went over there? And I guess even so, how did you scale it? Because it's often very difficult for UK headquartered consultancies to go across the pond.
So Chaucer's a really example because it was already quite an international business when we first got involved. So we probably de-internationalized it. Okay,
maybe not the best example then.
It had operations in Russia and Brazil, which were sort of quite fun, but probably for any number of reasons not the right place for where they should have been operating at the time. But on a more serious note, so Chaucer had a foothold in the US, but part of our period of investment that really scaled, and that. So generally, you go international sort of one of 3 or 4 ways. And I'm going to use the US as an example, but it can apply to other geographies. You buy something, you send somebody over, you recruit locally, or you follow a client. And the easiest one is probably recruit locally. And we've seen any number of examples where you typically recruit someone who is a sales-led individual because they need to sell the work, probably deliver the work, build a team around them is quite a hard thing to do. So you spend some time in country, you meet a bunch of people, and you try and recruit somebody to lead that practice in that geography. And that's generally quite hard with a high failure rate, because anybody that is convincing enough for you to back them with hundreds of thousands, if not millions of pounds of budget in order to set this business up is going to be a really great salesman. And the first person they're selling to is you. So, and that has worked. We've seen individuals create great practices doing that, but it does come with a high failure rate in our experience. The other sort of the next most sort of tangible or sort of frictionless way of doing it is generally sending somebody or a team out there. And we've seen that work quite well. And it goes back to that point around culture. If you're trying to set up in another country and sell what you're selling in the UK in a different geography, there'll always be differences in how you approach that. You'll have to adapt to the local market conditions. Your clients maybe want you to deliver in a different way. There might be different sort of economics around that. Will most certainly be different economics around it, given differential in wage rates and things like that. But if you can bring over a team, then you've got sort of ways of working. You have cultural consistency. You have the ability to that much better leverage the tools, the know-how, the IP, the case studies, the networks, the experiences of the people in your, the critical mass of your business back in the UK. So that can work. Following a client is probably the one that we've done the most. And usually the vast majority of the businesses that we work with have sort of enterprise clients. And so we work for them and hopefully do great work for them in the UK. And then that creates opportunity to go and do something overseas, again, sort of using the US as an example. So usually a combination of going with that client and then setting up locally, using people that are willing to come across from the UK and probably spend a year or two in country, which can be a great opportunity for people who are, maybe just below C-suite, go and build something, go to the US, experience that life for a year or two, generous expense account. That can be,
sounds like a good way to spend a couple of years, Alex.
I know. I wish I had that opportunity. And
when are you opening the US office for GCP?
Well, that's I've 2 young children, so I'm not sure I'll get that opportunity. But there's some very ambitious people here who might well relish it. So, yeah, I mean, look, that's the combination of working with a known client where you've got a revenue stream that's already kind of de-risked. It gets you up and running. It means that your P&L, you've got revenue coming in. It's not just cost going out. You're not open-ended in terms of how much are we going to fund this. That is often a really great way of sort of scaling out. And then that gives you the beachhead and then the platform. That means the recruitment piece is de-risked because you need to recruit locally, clearly. US tends to be a bit more expensive, but that's fine because task them, challenge them accordingly. And the prize is that much greater as well. So how do you then build that out? And that all involves quite careful selection of which city, which state, if you're sector aligned, that can determine where you need to land. And then how are you going to support that with, not only financially, but there's a whole bunch of tax, legal, regulatory kind of complexity associated with that as well. And one of the things that we do as a firm, because we have multiple businesses that operate in different geographies, again, a lot in the US, that know-how already exists, the networks already exist, the professional advice already exists. So we quite like an international expansion opportunity because we can see a route to, if the prize is there in terms of ultimate end client demand and scale of market, that can sort of significantly accelerate growth across the business and actually give a whole bunch of different options when it comes to that next exit, that next event. And actually one of the businesses I'm working with at the moment, sit on the board of, we invested in last year, CloudRock, that's one of our key kind of growth objectives. How do we scale in the US? And we're sort of working on that at the moment.
I think some great advice there. And yes, I've seen quite a few where, like you said, the easiest path is hire a local person to run it. But I love what you say, they're sales minded and the first person they sell is you. And the amount of times that goes wrong. Whereas, yes, I love the cultural piece. Like you say, if you're going to send people different time zone, hundreds, thousands of miles away, actually having that culture really helps set you off on that right foot. I want to turn, and I'm conscious of our time, so I'm trying to pick my areas for us to cover, Alex. And this may open up other things, but one that I realize we haven't necessarily defined, and I don't know how you would define this. You talked about value creation, and we've also then talked about profit. I'm inferring, and I ask this as much of my audience, value creation for you is enterprise value. So how much the business is worth at the end, which obviously has a link to if you make more money, you sell for more money. The question that leads me to, a bit sort of looking at your pillars, is almost beyond the profit What have you found has driven the enterprise value the most? Or conversely, what is it people often think drives enterprise value that doesn't?
This is a really exciting bit where we go deep into corporate finance. So I know everyone's been waiting for this bit. So really crudely, there's probably two dimensions to how you value a private business, and that's a P&L metric, which for the most part and generally 99% of consultancy transactions will be EBITDA or a similar profit metric, and then the multiple that you put on that. So those A times B gets you to the enterprise value and ultimately what the business is worth. We do a piece of work with all the companies that we back, and we present this not only to the board, but often quite deep in the organization, because generally there'll be a whole bunch of managers and employees who are in different forms of equity incentivization. We should maybe sort of come back to that, because I think it's quite important in terms of how you sort of differentiate, lock people in on the journey and reward talent in a consultancy. But taking that as read in terms of there are multiple kind of equity holders in the business, we do this piece of work presenting what we call sort of value levers, and that's how do you drive on EBITDA? How do you drive on the multiple that you attach to EBITDA? And that in itself is linked to those sort of 6 areas of value creation, or those 6 pillars that we've talked about. And some of these things are really objective. EBITDA is an objective number. You report it in your annual accounts. It can be an audited number depending on the scale of the business, and then you have a budget and you sort of support that and look forward to it. The multiple is a bit more subjective, but that will have financial and non-financial elements sort of feeding into it. So that can be things like, not being dependent on a single customer or series of customers. It can be, how quickly is the top line growing? It can be how high are your margins? It can be how strong is your cash conversion? It might be how differentiated and scarce the thing you're doing is. It might be actually you just happen to be aligned either or consciously or by accident with a particular technology that's actually growing really, really rapidly, and you stand out in your particular market or geography as a consultancy that is very heavily aligned with that and therefore in demand. So all of these sort of objective and subjective criteria coming together feed into that multiple, and then that ultimately is how you kind of get to the valuation. That's only ever a guide though, because ultimately the valuation is what a third party pays for the business, but we quite frequently draw on precedent transactions and how quoted companies are valued in order to sort of influence what we think an appropriate multiple is when you come to that next event.
If you are listening to this because you want to improve your consultancy or your practice area or just your career, then I want to give you something that will help you supercharge that on top of this, focused on marketing. If you go to our website, createengage.co.uk/insights, you can download our super detailed ROI-driven strategy framework ebook. In that, we go into detail on exactly what you need to do to build an effective marketing strategy, to build a strategy that will deliver you ROI and help you achieve your growth goals. So take that link, download it, and enjoy that after the end of this episode. This may be useful or may not, but I do wonder more so with businesses that you buy into. Obviously, you mentioned around the kind of EBIT or EBITDA, and most of our listeners will be familiar with that. I guess in consulting businesses, after the E, do you get much of the ITDA?
Okay, we're going into a technical accounting question. Okay.
Well, I guess I only ask it. Well, I ask it for a couple of reasons. One is, thinking, what are those levers you can pull? Also, if people are trying to structure their businesses, if you've got a bunch of cash sitting on the books, can you dividend it out to yourself and just take, a massive bank loan? And then how do people think about that? And then to your point, I'm pretty much at the end of my corporate finance knowledge here, Alex. So I might stop shortly after.
Yeah, that's a relief because we're getting to the end of mine as well. But so, I mean, very, very simply, consultancy businesses are asset light. They won't have much in the way of sort of CapEx and depreciation. Tax is tax. So depending on how profitable you are, will largely determine that number. And then interest will just depend on the capital structure. And generally that a private equity deal tends to come with an element of leverage. But again, our focus in particular is always that needs to be sort of appropriate to the scale of the organization. You don't want to inhibit growth by over leveraging. The fundamental of how driving the EBITDA, driving profitability in the business, generally in a consultancy, will be a product of growth, say revenue growth, top line. It will be a product of how you're managing that gross margin. And that's essentially how efficient you are in terms of utilization and making sure that non-utilized resources, people that you're paying essentially to do work, if they're not billable, well, how are you solving that problem? What's a tolerance that you're willing to accept in terms of non-billable time? And there is value associated with that. People who are non-billable, it can be a bit of downtime. It can give space for training. It can give opportunity to sort of build out collateral and help with sort of development of thought leadership. So it's absolutely not wasted time or dead time, but you just need to be quite careful about what you're prepared to sort of tolerate there, and then actually what the levers you can pull if that number starts to become a bit unattractive. And then finally, your overheads, and ultimately that is the cost in the business that enables you to deliver the frontline service and on-sell the next project and build out the pipeline that we talked about earlier. That's the area where if you've got cash or if you've got P&L, thinking about reinvesting in the business, and this is what we do quite frequently. If we get involved with a business and the overhead stays the same as you go on a journey from 10 million revenue to 40 million revenue, it means either the business was wildly overweight when we first got involved, which rarely is the case, or it means that we've underinvested in the business and we've potentially inhibited growth, or indeed, frankly, you're storing up a problem for the future in terms of governance, sales, pipeline, et cetera, et cetera. So having that kind of tension between delivering profitability but also reinvesting in the business is something that, again, board level matter, we sort of think about quite carefully. There are certain metrics that you try and sort of adhere to, or at least have a sense check to make sure that you're not overweight, underweight. But again, thinking about areas where you can put investment back in the business, that tends to be good quality people. That might be another high quality sales individual. It might be some more technical leadership. It might be somebody on a marketing side to sort of help with, how the world understands your proposition, your go to market, what you want to be famous for. It might even be, more investment in sort of finance and governance, because get better quality information out of your business, then you can make better or certainly more informed decisions. So if a founder or an owner is in the happy position of saying, actually, my business is almost making too much money, so what do I do with it? It doesn't feel right.
We all wish we were there, Alex.
Exactly, that happy problem. Then looking at where they can kind of reinvest back in that overhead, I think that's probably what are the 2 or 3 key strategic initiatives that you think will support growth, and where does that investment need to go in order to sort of help that? The one thing I'd just sort of add on that is when you're making that decision, think about the proof points. What does good look like in terms of that investment? What's your return on that investment? That can be a financial metric, or it could even be this is what we want to achieve. And so, what's the time frame that we're going to do this in? How are we going to establish whether we've achieved it or not? What are we going to task the person delivering on that with in terms of their objectives? So just having that little bit of a plan around it is always a good idea to make sure you're not chucking good money after bad.
Well, I think great answers to our corporate finance question. And also, I think implicit in there, to your point, the happy problem is I've got too much money. I guess there's an interesting, assessment for anyone listening as well of am I underinvesting in my, operating expenses to massage a profit at the bottom? And actually, I love what you say around storing problems up in the future. Actually, is that whether you want investment or growth? Are you storing those problems up by squeezing the operating expenses rather than looking at the kind of gross margin above?
Yeah, so the temptation is always to run lean, and that's great. You want to be efficient, and particularly when it's your own money, and the business is often the major source of not only income but wealth for the founder that set it up, and there are a whole load of potential dependents on the success of that business. And that's mortgages and sort of future financial planning and security of family and things like that. So I don't for a second ever suggest being lean is a bad thing. You should be efficient, particularly in those early years. Putting a bit of cash aside for a rainy day, anticipating where a project might end, and you might have to sort of bridge a period where your revenues have come off a little bit and you still want to keep good quality people on the payroll. All of those things. Erring on the side of being lean with your overhead is almost certainly the better way to be in those early years. You're kind of bootstrapping the business and scaling it. The piece that I'm talking about is generally when you're through that kind of scale up phase, quite often when you brought on board a partner like ourselves, and then the agenda kind of shifts a bit to, well, that profitability is important. We will never, ever neglect EBITDA margin, and it'll be a metric that we watch very, very closely. But let's not lose sight of investing back in the business in order to support growth, because growth solves all those other problems. So again, that tension exists. And the other thing that I'd also say on the overheads, and we are deep into P&L kind of analysis here, but with the overheads as well, you might not need to spend more money. You might just need to spend the money that you're spending in a better way. So just a little bit of self-reflection on some of the programs that you've implemented, some of the spending programs that you've implemented, or some of the people that you've recruited. Just a little sense check from time to time to make sure that you're still getting value from those. Or, do you need to just make a little tweak in order to get a bit more value, get a bit more return from that spend?
No, I think really helpful, and yes, it is deep, but I love the detail, and I always think I know my listeners value it as well. And I'd say one last area for us, which brings us to something you touched on in that section around the importance of, and I know you've done with some of your kind of companies you've invested in, is that equity incentivization. Because again, it's an interesting thing in a consulting environment where sometimes they're LLPs, sometimes if not, it's 100% founder owned. How do you approach that, to your point, to get the buy-in from the right people in the organization? And also, how do you kind of, in some ways, I imagine the founders already bought in. If they've, if you've invested, they've given you've bought in equities, they're open to it. But how do you get them to be open to, in effect, giving away more?
Yeah, that's, again, usually if they've taken on our investment, then there is a sweet equity pot that we call it, industry term. That generally means a proportion of the equity of the business that is for the benefit of other managers who aren't necessarily the founders and certainly aren't the private equity house. And the reason we do that, we recognize the value of equity, again, clues in the name of the industry. We want to align and incentivize behaviors to create equity value for all shareholders, which sounds very sort of grand and serious. But what it really means is making sure that if we're on a 3, 4, 5 year journey where we ultimately want to deliver a good return for our investors, the people who are most capable of driving that, or they're closest to the action where ultimately that will, or everything else in terms of how value creation stems from, they're the ones that are aligned with us and they're thinking about that prize for themselves, not just for the private equity house that's sort of faceless that they may or may not have met. And so we see that have value in a number of different ways. One, that direct financial incentive. How do you differentiate your consultancy that might be 100 to 200 people? You'll have really great people and they will get phone calls from recruiters. They'll have friends working in other consultancies or in other similar businesses. How do you get them to say, well, actually, I'm going nowhere. I'm really focused on this. And if anything, I want to go deeper with this organization. Well, you can differentiate them by making them a shareholder, an option holder, and aligning them with the objectives of what it is you're trying to do as a founder. And indeed, what we're collectively trying to do as, a board and investors. The other piece with it, I think, is the psychological sense of being a proprietor, of having ownership of this being my company as well. So even if I've got a relatively small proportion of it, I'm going to think about that differently. I'm not just an employee. This is something that, I'm a stakeholder in, I'm a part of. And that, more often than not, I think people do get that. Some people won't value that, and that's fine. But a lot of people do. You've been brought into something. And actually, a lot of the time with equity, we see the value almost being in the recognition that other people have got this and it has value, and then the determination to say, okay, what do I need to do in my career in order to be in that club and to be, how do I participate next time around? So we think, we see that as having a lot of positive associations for not just the C-suite, not just that immediate next rung down, but actually deeper into the organization.
And to your point of, we've talked about a few topics today where there's been a kind of stage point, like you mentioned around kind of staying lean when you're bootstrapping and then doing that. In that equity context, for anyone listening, is there a point in the journey at which this is more or less beneficial? If I'm just starting out, should I do it? If I'm 5 million, should I do it?
That's a really good question. And this is really where it's subjective rather than objective. I don't think there's a particular milestone when you go, right, we've got to X million of revenue or X number of employees, and this is where we start dishing out a proportion of the company in shares. In fact, I'd say actually that's a really bad way to think about it. This comes down to who's creating and driving value in the organization. And you can go quite a long way, as we've discussed earlier, where a founder is inspirational, owns all the client relationships, they're driving it, and it's all about them. There comes a point where actually you, by necessity, have to delegate. By accident or design, you find other talented people in the organization who clients love, and they start to build their own reputation or their own practice area or their own book of business. And so just being alive to who's successful in your organization that is creating value ultimately for you as a founder and other shareholders, and what would happen to your business if they were to leave, if they were to get that phone call from the bigger consultancy that said, look, we're going to give you a 25, we've heard great things, we're going to give you a 25, 30, 40, 50% bump on your salary. Come and do these great things over here. What would that do to your business? What would the loss be there? And just being a little bit mindful of getting in front of that problem, rewarding, incentivizing, binding people in before they decide, actually, I've done great work here, I'm being well paid, but am I being properly rewarded for the value that I'm creating? Because people will think that they will be aware. They know if they're running a £1 million client or a 10 million quid client and how important they are to the organization. Getting ahead of that problem, it will, if anything, bind them closer and incentivize them to sort of go harder and again, sort of fulfill their own kind of entrepreneurial tendencies within your own organization.
I think a great point. And like you say, I think it brings it home in that, yes, those phone calls are happening every day, as we all know, and actually thinking, what would happen if this, rather than thinking of the loss to you in terms of I've got to give a X% share, think what would happen to the business if we lost this person, if they are a key person. I think it comes back to your point of speed, I guess, doesn't it? Is if I've got to go out, recruit, train, etc., is that going to add 1, 2, 3, 4, 5 years? Am I better off giving them this to bind them and bring them on that journey?
Yeah, and it's also thinking about that in the context of your employee value proposition, the long-term succession planning, goes back to themes we talked about identifying talent within the organization. So none of this this should be a positive, ongoing kind of assessment within the business. So even if individual X is absolutely superb at their job and their client loves them, getting ahead of, okay, are they appropriately incentivized? Are they aligned with what I'm trying to achieve with the business? But then equally, are there other people in their team or other people coming up through the organization that can de-risk that individual? Thinking, just having that as a live kind of assessment in the organization. Again, these are people organizations, so everything always comes back to people and the right people on the bus and the right people in your team. So just having that as a live debate at board level and again, anticipating the problems and being ahead of them, but just recognizing that equity can be a useful tool in solving some of those problems.
And then I'd say the very last question before I have a couple of wrap-up questions, Alex, that I always ask people, but probably the last question that will nicely close this off for our listeners. And I realized right at the start of this, I said I went chronological, and I've lied, because this is actually the first step in any journey, which is, do I take private equity investment? And I'd be fascinated in, we've covered all of the ways private equity helps in the growth journey. For anyone listening to this who is thinking, do I, don't I? What's that advice you give people? What makes private equity the right route at the right time or the wrong route at the wrong time?
Probably goes back a little bit to what I said earlier in the conversation. Think about what you want from the private equity relationship. So clearly there needs to be a financial element to that. Amazingly, people probably wouldn't talk to us that much if we didn't have a check to write. So
I'm sure you're lovely people to have lunch with as well, Alex.
We occasionally have a good lunch. But so on a more serious note, thinking about what you want from that relationship, where are the areas of the business that I could benefit from that external partner coming in to sort of help me support, evolve, scale, go quicker. So being mindful about that. I think being self-aware in terms of where you are with maturity. Private equity investment is the start of another journey. It's not the end point. So absolutely think about de-risking and what you want from it in a kind of commercial and financial sense, but then recognizing that you're going on a new journey with a new business partner. And so thinking about how you want that journey to play out, what does good look like? Just being quite clear on that. And then I think linked to that as well is how ready are you for that process? Probably the only time it can be challenging is if you embark on trying to raise private equity funding and you're not properly set up or prepared for it. So taking the time, making sure that you're thinking about the systems, processes, information, and people bandwidth in the organization. If you're telling a story about why your business is highly attractive and this is why you should be able to raise X amount of money, are you prepped in terms of the data and the proof points behind that to support the story? Because it can be a really distracting thing. It's ultimately private equity. We look after other people's money for the most part. Certainly at GCP, we take that really seriously. We invest our own money as well, but we have a duty of care. And so unfortunately, due diligence is a part of what we do. So just making sure that the business is set up, prepared in the right way in order to go on that process of due diligence, even if that means that you delay your start and you just take a few more months to get ready, I would sort of ponder on that. The most important thing, and the thing that I would urge any listener out there thinking about this, it's a really, really personal relationship. Yes, GCP, we're a financial institution. Don't think we're particularly institutional, but we are, that's what we do. But equally, the relationship is a personal one. So we're not a very large organization. We're sort of 15 people, give or take, in the investment team, 6 partners. We all have very personal business, but actually also friendships with the CEOs, the founders that we work with. And I've been privileged enough to work with some fantastic founders over the years. And they're people that you share successes with. They're people that you share problems with. You are going on a journey together, and you're placing quite a lot of trust in them in order to be the right vehicle for the money that you're trying to invest. And they're placing quite a lot of trust in you in that they're letting you into their business. They're putting you at the table alongside them. You have a stake in their business in something that can be very, very personal to them, a labor of love and a lifetime's work. So that kind of mutual respect and good working relationship and even friendship, I do think that's important. Life's too short to go on that journey with people you don't get on with. So test that quite thoroughly before you sign those legal docs.
I think great advice, Alex, and a nice place to draw us to the last few questions, which are my quickfire ones I ask all guests. I will start these with, say, one of my favorites. And I also preface this, you might not be a reader. Some of my guests are, some aren't. So if book is not something that if you're not a big reader, what you go to, I'd be interested in. But the question is, what is the book you've given the most or has had the biggest impact on you, and why was that?
So usually this is where you sort of roll out a bunch of different business books and try and convince people that I've read them all. So Good to Great by Jim Collins is a really good book. And if you're going to read one, I'd read that. Lots of people have over the years. I found it super interesting, made me think about problems in a slightly different way. And I still occasionally dip back into that. But I've not gifted that book, actually. The one I have gifted, we've done quite a lot in tech services. And as a non-technologist, I found The Phoenix Project by Gene Kim really, really good as an intro to that whole space. And the follow-on was a book called The Unicorn Project. And actually, I have given copies of that to different people on the team, or certainly recommended them. But the book I've probably gifted the most is a novel, and I thoroughly enjoyed it, and it made me think about things, and that's Great Gatsby. And it's also got the benefit of being a relatively short book as well. So when you gift it to people, they probably feel obliged that they should read it rather than just put it on the bookshelf and have it sitting there looking pretty. So that's a novel that has probably meant something to me, and I've learned things from, and that's why I've regifted it the most.
Amazing. Well, and to your point of what I like here is the business books as much as the non-business books, because as you're touching on there, you can get a lot from, and just frankly enjoy, books that are not about work. You said it kind of had an impact on you, gave you a lot to think about. What was that key thing it made you think?
So it's turning into a book review now. So I'm glad we've moved on from corporate finance.
We go everywhere, Alex.
It goes back to sort of change, identity, how you evolve both in your professional life and your personal life, and sort of different stages of that career journey and dealing with highs and lows, and how you react in those circumstances. And a common thread of being, the same person you are starting out the beginning of your career, where you don't really know an awful lot, and quite a lot of the time it can be a bit nervous and scary. And then, when you've had some successes, dealing with those in the same way and celebrating them, but also, remaining humble, or at least sort of thoughtful about how you've arrived at them, and giving credit to the people that have supported you along the way, because it's never a solo thing. And then equally dealing with setbacks as well. Again, that's a book that sort of touches on aspects of that. And again, is just something that I wouldn't say resonated, but just made me think about things slightly differently. And so that's why I enjoyed it.
I love that. Well, and it nicely, Alex, brings us to our next question, which, given your role in the consulting ecosystem, I'll have to ask slightly differently, but it's an advice question for people in the consulting industry. And the question, and I will kind of let you guide this, given the firms you've worked with, but it's, you've got 3 people in front of you, and these could be people in the portfolio companies you're working, someone who's early in their career, they're just starting out, someone who's, in that middle stage, 4, 5, 6 years in, and someone who, in a consulting, kind of a traditional consulting context, I'd say approaching partner, but you could just as easily say, approaching board, you mentioned it with the kind of international expansion. And if those were people in your portfolio companies, what one piece of advice would you give to each, or what advice would you give to all?
I'll call this the you're at the away day or the strategy day, and you get chatting to somebody over a beer kind of question, because quite frequently, actually, it's one of the things we really enjoy doing. You get to meet a whole bunch of different people across the organization, and you can have a whole bunch of random conversations, which is great. So I'll have a go at answering it. And again, I'm not, as we've established, I'm not a consultant, so slightly external lens on this. But so the individual starting their career in consulting, I would probably suggest getting that as wide an experience as possible, working with a whole series of different clients, trying to experience different end sectors and becoming quite curious and familiar with them, but remaining curious about what makes those sectors tick. So not just the problem that's in front of you, but actually what's the business objective for the client that you're trying to solve, and being curious about that. The one sort of 4 or 5 years in, I'd be thinking it's never too early to start thinking about selling and being commercial. And that, you're probably not there like leading a pitch or having a revenue target on your back, but thinking about where you can on-sell additional services or where you can grow the account, or if there's an opportunity that somebody else in the organization should be following up on, joining the dots, networking. I'd be really sort of starting to focus on that. And if you're not doing, it's really easy to get stuck in I'm doing really great work, I'm down in the detail, I'm meeting my deliverables, but just elevating a little bit and just thinking about, okay, how do I get a bit more commercial about this? How do I start to think about revenue generating? And then for the third individual, the one approaching partner or eyeing up, what's my route to the board? It's probably an extension of that second one, which is start really thinking about how you create business value. Again, it could be really tempting to say, well, I've done an excellent delivery. I should be a partner because I delivered this project really well. And that's a really valid, high value thing to do. So I totally understand that. But how do you then link that to a business outcome? How am I going to create stakeholder, shareholder value? And I've got a route. I think if we do X and Y, this is how we can create value. I want to come and have a conversation with you about that, because I think it's a really good idea. And I've done some work behind it. And oh, by the way, I'm thinking about my career and where I want to go in this firm. And, that's a very forward thinking conversation that anybody around the board table, any shareholder, any private equity investor would be delighted to have over a beer or otherwise.
I think some great advice. And to your point, I always think getting different perspectives, and for yourself being that investor into that last piece, that kind of value and the value people can add to the business, I think is a fantastic point. And Alex, this has been great. Thank you. The very last question, if anyone's listened to this, they want to find out more about yourself, more about GCP, where would you point them to? Where can they get in touch?
So our website is the best place to start. So we're growthcapital.co.uk. My profile and contact details are there. And I'm also on LinkedIn, Alexander Thomson.
Amazing, Alex. We'll put links to both of those in the show notes. And otherwise, thank you for this. I've really enjoyed it, and all the best for the rest of your day.
That's great. Thanks, Nick.
Cheers, Alex.
Today's episode is brought to you by Create Engage, the specialist digital marketing agency for the disruptive management consultancy. Now, for long-time listeners, you will probably already know who we are. You may have even heard one of our ads on a previous episode of this podcast. But for those of you who don't, here is a short introduction. At Create Engage, we help you create an effective marketing strategy for your consultancy, a strategy that will resonate with your target clients. And then we support you by delivering the campaigns you need to turn that strategy into a reality, helping you to build your brand, raise your profile with your prospective clients, and ultimately generate return on investment from your marketing activity. Now, I could tell you about many of the great clients that we work with and the results we've delivered for them. But instead, I'm going to do something much more powerful, and something that I would recommend you do for your own marketing. I'm going to let our clients do the talking for us. If you are currently thinking about marketing for your consultancy, you're going to want to listen to this.
Create Engage started the process for us. They managed it end to end. They came up with some really creative ideas, and we were really happy with the work that they did, which meant that we could just focus on running the business. Not only did we start conversations with clients that we hadn't spoken to before, but also there was tangible return on investment by some work that we were given.
They've helped right from the initial shaping of the idea through to helping us work out what our end goal was. They've supported us with the visual identity and our positioning of the brand.
We've had an immediate expansion of our network and have initiated a raft of new conversations with owners, CEOs in target client organisations, and has led to us winning new projects already.
One of the greatest compliments, I guess, is that one of our competitors even said that they really like what we're doing with marketing. They wish they could be doing something as good.
So from our perspective, we couldn't recommend Create Engage any more than this.
I would certainly recommend Create Engage if you're a consulting firm they really understand consultancies and the sort of challenges we face. And, I don't think you're going to get much better marketing anywhere else.
So I wouldn't hesitate to recommend Create Engage. They did a really good job for us.
So if you're looking for an agency that can help you achieve the results that our clients just described, then head to our website, createengage.co.uk, where you can find out more about how we support consulting firms like you. You can download our latest ebook and you can get in touch to talk about how we can help you take your consultancy to the next level through digital marketing. I hope you enjoyed today's episode of Climbing Consulting. If you have any guest recommendations, comments, ideas, thoughts on how I can make this show better for you, just drop me an email. It's nick@createengage.co.uk, and I really look forward to hearing from you.